In the year 2008, the world was introduced to a revolutionary concept, Bitcoin. This digital currency, the brainchild of the enigmatic Satoshi Nakamoto, promised to change the way we think about money. Bitcoin emerged from the aftermath of the 2008 financial crisis. It offered a decentralized alternative to traditional financial systems. This new form of currency operates independently of central banks and governments. It relies on cryptography and a distributed ledger technology known as blockchain. Bitcoin's arrival marked a paradigm shift. It introduced the concept of peer-to-peer electronic cash. This meant that transactions could occur directly between parties. No intermediaries like banks were needed. This innovative approach challenged the established financial order. It sparked a debate about the future of money. Despite initial skepticism, Bitcoin gained traction. Its decentralized nature, coupled with the promise of anonymity, attracted a growing community of users and investors. The early years were marked by volatility and uncertainty. However, Bitcoin's underlying technology, the blockchain, began to garner attention. The creation of Bitcoin was not just about a new currency, it was about a new system. This system promised transparency, security, and accessibility. The journey of Bitcoin from an obscure white paper to a global phenomenon is a testament to the power of disruptive technology. It continues to challenge and reshape the financial landscape. Bitcoin, at its core, is a digital currency. It exists solely in the digital realm. Unlike traditional currencies, it is not backed by a physical commodity like gold or by government decree. Instead, its value is derived from its scarcity and its utility as a medium of exchange. Imagine Bitcoin as a digital token. This token can be transferred electronically from one person to another. These transactions are recorded on a public ledger called the blockchain. The blockchain acts as a transparent and immutable record of all Bitcoin transactions. This ensures accountability and prevents double spending. One of the key characteristics of Bitcoin is its decentralization. No single entity controls it. It operates on a global network of computers. These computers work together to validate and process transactions. This distributed nature makes Bitcoin resistant to censorship and manipulation. Bitcoin transactions are secured using cryptography. Cryptography is a method of using complex codes to secure communications. This ensures the authenticity of transactions and protects them from fraud. The use of cryptography makes Bitcoin transactions highly secure and virtually impossible to counterfeit. The process of creating new Bitcoins is known as mining. This process involves solving complex mathematical problems. Specialized computers, often referred to as mining rigs, compete to solve these problems. The first miner to solve the problem adds a new block of transactions to the blockchain. This block is then broadcast to the entire network for verification. Miners are rewarded for their efforts with newly created Bitcoins. This process is analogous to gold miners who expend resources to extract gold from the earth. The difficulty of the mining process is adjusted periodically to ensure that new Bitcoins are created at a steady and predictable rate. This controlled issuance rate is designed to mimic the scarcity of precious metals like gold. The mining process serves several crucial functions within the Bitcoin ecosystem. Firstly, it ensures the security of the network. The computational power required to mine Bitcoin makes it extremely difficult for any single entity to gain control of the network. Secondly, it verifies and confirms transactions. By solving the mathematical problems, miners ensure that transactions are legitimate and that no double spending has occurred. Furthermore, mining plays a crucial role in maintaining the decentralized nature of Bitcoin. As the mining process is resource-intensive, it incentivizes miners to distribute themselves globally. This prevents any single entity from controlling a majority of the network's hash rate. The distributed nature of mining contributes to the resilience and censorship resistance of the Bitcoin network. Section 4, the Bitcoin marketplace, where supply meets demand. The value of Bitcoin is determined by the forces of supply and demand. Just like any other asset, its price fluctuates based on market sentiment and trading activity. Bitcoin exchanges, which are online platforms where buyers and sellers meet, play a crucial role in price discovery. When demand for Bitcoin exceeds supply, its price tends to rise. Conversely, when supply outweighs demand, the price tends to fall. Several factors can influence the demand for Bitcoin. These factors include news events, regulatory developments, technological advancements, and macroeconomic trends. For example, positive news coverage of Bitcoin's adoption by mainstream companies or institutions can lead to increased demand and a subsequent price surge. On the other hand, negative news events such as security breaches or government crackdowns can trigger panic selling and a price decline. The limited supply of Bitcoin, capped at 21 million coins, is a key factor influencing its value. As more Bitcoins are mined and the supply gradually approaches its limit, the scarcity factor is expected to become more prominent, potentially putting upward pressure on the price. As we wrap up our journey into the world of Bitcoin, remember to like, share, and subscribe for more insightful content. Stay tuned for more on the future of digital currencies.